So Isaac's just dropped a question. What up, Isaac? Thank you so much. He was with us on season 3. So Isaac says, if you were to invest in real estate, would you opt for the UK or the continent first? Both of you can take this. Kwasi, I'm also curious to hear your ideas behind this as well, as I know you've been doing some traveling as well.
Yeah, that's a great question, Isaac. Thank you for the question. Just to go back on a couple of points though, when we're talking about inflation, I just in reality, so we talked about stocks and shares, ISAs, etc. Those are ways that you can invest and grow wealth, but that doesn't necessarily mean that you're going to beat inflation. Remember that inflation is the general cost of rises happening over time. Mm-hmm. So to beat inflation, the stock price needs to go up by more than inflation, because inflation is always going up. That's the first point I just wanted to point out. Just because you invest doesn't mean you beat inflation. There are fundamentally about...
That's hilarious. It's true. It's not that easy. It's not that simple. It has to exceed what the inflation price is. Because if it's not, because it's going to catch up. Yeah. Sorry, continue.
I mean, but just to double click on that, like Michael rightly points out, inflation is probably 6.7%. Bank of England said it's probably going to be closer to 10%. I think it's going to be higher than that personally, or unofficially or officially. Actually, in inflation, one thing that people always forget is that it's expensive to be poor. Inflation at the poor end of things, we're talking about 6%. It's probably more than 50%. Give you an example. If you go to Asda and want to buy their basic pasta, so not the one that's been flown in from Italy and it's all different colors. I'm talking about the own brand basic pasta. The price of that has gone up 50%. Right? So, the inflation is really an average, but nobody is an average. Nothing is average. Everything is always one or the other. And that 6.7% is everything averaged in, but some things in that bucket are 50%. Some things are maybe 1 or 2%.
Yeah, I agree.
Or 6.7%.
You need to look at your basket as well. It's the same thing. For me, inflation is when I go down to the local and I see bread costing £1.29 when it used to be 89p. That's the one that always stresses me out when I walk into the shop and I'm like, why is bread so expensive? You know what I mean?
The basic things, right?
Yeah, it's the basic things. But these are the things that creep up on you because these are the things that you're regularly buying. If you're not doing the bulk buy, if you're not going to the Lidl, the Asda, the Tesco's and doing the bulk buy, and you go to the local shop, it all starts to add up. You know what I mean? And these are the small expenses that creep up on people that they're not really keeping an eye on, and they don't understand that for them, inflation might be 20%, it might be 30%.
Exactly.
Because
so I think, so it's important to bear that. But when we talk about investing, I think there are many things you can invest in, but fundamentally there are only 3 things that really beat inflation, and none of those 3 is gold. To be clear, people often talk about gold being a great hedge against inflation, but factually it's not based on the data. So if you really want to beat inflation, there's 2 things that probably you will know about, which is real estate. I'll come back to that and I'll answer Isaac's question.
Yeah.
The other one is commodities. So when I talk about commodities, I'm talking about things like oil, rare minerals, metals, other stuff. We can't go and buy a barrel of oil and come keep it in our back garden. Or I'm not really about to go buy some, palladium or whatever and store it. That's where the previous conversation around ETFs comes in, exchange traded funds, which were mentioned. So you can get ETFs for commodities, either as a basket of commodities or specific commodities. So commodities are number 2. And then the third thing, which most people don't really know or care about, something called TIPS. It's a type of bond. And it's from the Treasury, the US, and it's inflation protected Treasury bonds, basically. And so those were effectively, they give you a return inflation plus. So whatever inflation is, they'll give you that plus whatever. So those are the 3 ways that you can beat inflation. Coming back to real estate, I think real estate, one of the main reasons why real estate tends to beat inflation is because of leverage, borrowing money to buy an asset, which you then only pay for the repayments on the mortgage and you get the income. The problem there is that you can possibly inflate away the debt. So if you have a debt and you're paying a fixed return on that debt and inflation is going up, then in real terms, the value of that debt stays the same, but obviously inflation is going up, so you're deflating away the debt, if that makes sense. The problem with that argument actually we're talking about here is that in an inflationary market, everything else is going up. We haven't touched on this, but interest rates are the core thing. I mentioned that the best thing about property you buy with leverage. We've been living in a low interest rate environment for the last 15 years since I started working, basically.
True.
But now interest rates are going up. They've gone up from 0.1% to nearly 1% in the space of about 3 months, right? And the only direction of travel is up. So that's going to impact the return on real estate if you're buying with leverage. And that's something that's really important to understand. Location. So would I buy in the UK or would I buy on the continent first? I mean, there's two ways to look at this. So generally, I think when you're buying real estate, the location is important only insofar as your strategy. It doesn't matter whether I buy on the continent or UK first. It just depends what strategy I want to apply. If I want something that is going to be like, if I want to buy something that is going to be relatively hands off, I'm gonna, maybe I have euros sitting around in a foreign currency that I'm investing. And I don't need pounds, so the exchange rate doesn't matter. So if the money comes back to me in euros and it's gone down by 10% every week, that doesn't matter to me. All of those things are what I consider. I don't think I would do both is the simple answer. UK and continent, not one or the other.
But what if the money is limited? What if you got to choose one? What if you got to choose one? You can't have both sometimes. As much as I like to buy both rather than just setting up for one.
I guess for me, my dad's always said to me, if I wanna do business in Ghana, for example, I need to be there. That was the one thing that's, if anything's held me back from investing in that area, because I haven't actively been running back and forth there as I would like. So I think it really does depend on your preference, and I think you need to think about your long-term prospects with this as well. Where do you plan to be in the long term? If you're planning to go back to the continent, is that a place that, although you may be renting out now or using for investment purposes now, are you planning to live in it later? So what does that look like? Are you buying a hotel? Are you buying part of a hotel? And Kwasi mentioned as well about the currency exchange rate. The money might not go that great when it's coming back to the UK. Do you know what I mean? So it really depends on what you're trying to do for the long term and where you're planning to use that money. Because a lot of people focus on getting into the investment, but a lot of people don't think about the exit strategy of the investment.
Or even the holding. You're so right. People don't think about the exit strategy, but to be honest, people don't even think about the holding period.
Yeah.
All they want to do is I want to get into an investment, but once you have it and you're in it, you then have to hold it. And then, as you say, Michael, you then have to exit. So, such a good point that, entry, holding period, exit are all key.
And holding is just as important, because even if we talk about real estate in the UK, the London is probably one of the biggest places in the UK where people are investing in property. And so much so, it's even more than pensions in the UK. But if you talk to a lot of people that are investing in property in London, they're not all making money in the short term because of the additional costs that they need to take into account when they're renting out the property. If they own it, some people are becoming accidental landlords because of the fact that they've either received property for inheritance or they decided to invest in real estate, and they're not taking into account the real value of the investment from a net perspective. So we've got the gross rental income, but we also need to take into account
the nets,
the fees, the mortgage, any other costs, and then tax.
There you go. Tax. The biggest sting of them all, right?
Yeah.
The Grim Reaper himself.
It's coming for all of us. You know what I mean? So death and taxes.
The problem with tax is that it's coming for
two things certain in life, death and taxes, right? Who said Who said that? Remember? I'm trying to remember who said that.
I think it was Rockefeller. But the problem with property is that the problem with taxes is that they're coming for property investors in a different kind of way. Especially in the UK. So maybe that part answers your question, Isaac. The one thing that would attract me to the continent or to anywhere else is the tax situation. In places like America or anywhere in the world, when you have a property and you pay a mortgage on the property, you're able to deduct that mortgage from your costs, from your overall cost of running the business, and then whatever's left is your profit, and that's what you pay interest, you pay tax on. So you have your income, you deduct all your costs, whether that's mortgage, repairs, handyman services, local taxes, council tax. Deduct all of that. You have a number left over, and then you pay tax as a percentage of that, 20% of that.
It's crazy.
The problem with property is that the biggest cost in property is your mortgage. So your mortgage will probably make up sometimes up to 50% of your overall costs. Now, that's not an allowable expense for tax purposes. So even though you're paying that mortgage, according to the tax man, that's profit in your pocket, and they use that to calculate your tax. You could end up basically paying more tax than you're making in profit.
It's crazy. It's absolutely savage.
Yeah.
It's so savage, the system. It's so savage, the system. Beauty Stick says it's a personal choice, no right or wrong answer.